and we'll move on to our webinar. So we will share our presentation now, and I'm happy to move into the main topic for today, which is I know why you are all here, as exciting as the AGMs are. But I'd like to welcome everybody to attend our webinar today, titled Canada's Macroprudential Framework Pre and Post COVID-19, the highlights and low points of the government's response and its impact on the housing market, with Paul Taylor, President and CEO of Mortgage Professionals Canada. We certainly appreciate Paul and taking the time to speak with us today, as he's very knowledgeable on all subjects related to this, so we look forward to the chat. Before we move into that, I just want to mention that there is a question and answer session afterwards. We've left a lot of time open for that, so anybody that has any questions, please use the chat function in Zoom in order to submit questions for the chat, and I'll help facilitate a Q&A with Paul after his initial speaking notes. We certainly would like to acknowledge our title sponsor, Valley First, a division of First West Credit Union. We can only do these sort of events with our sponsors, so we're very grateful for Valley First for sponsoring today. With Valley First, whether you're starting a business, growing it, or looking to transition out of it, Valley First, which is a division of First West Credit Union, understands your business and its needs from a holistic perspective. They have a specialized and experienced commercial team that can support you with day-to-day operational banking, payroll, and merchant services, to accessing additional funds, to safeguarding your business through insurance, to fueling your growth through investment solutions. Valley First team of commercial banking advisors will partner with you every step of the way when financing residential or commercial projects. They are committed to the Thompson, Okanagan, and Similkameen Valleys, and have a strong, long-standing partnership with UDI Okanagan Chapter. So at this time, I'd like to call on Jamie Chawartha, Senior Commercial Banking Advisor with Valley First, to introduce today's speaker, and then we will pass things along to Paul to get us started. Jamie.
Great, thank you, Luke. Valley First is happy to be the title sponsor of this event, and we'd like to thank the team at UDI for organizing this webinar. I have the pleasure of introducing today's speaker, Paul Taylor, President and CEO of Mortgage Professionals Canada. Appointed in January 2016, Paul works alongside the Board of Directors to execute the strategic priorities for the National Association. Some of these priorities include championing government relations, improving membership and consumer engagement, and providing education opportunities. Paul is a seasoned association executive, bringing 11 years of experience from a prior association role where he served the insurance broker community. Before joining Mortgage Professionals Canada, Paul spent 3 years leading the Canadian sales effort for an enterprise communication software company. And in his early career, he was a facilitator and course designer of insurance materials for a prominent Canadian property and casualty insurer. Paul is a proven leader with extensive background in sales, operations, education, marketing, and government relations. He earned his MBA from the Richard Ivey School of Business at Western University in 2014. He also holds an honors diploma in jazz performance from Humber College, which he earned when he was young, idealistic, and thought he could somehow make a living by playing the guitar. Paul, over to you.
Thanks very much indeed for the introduction there, Jamie. Thank you very much indeed for the invitation to present today as well. UDI, and thank you Valley First as well for being a sponsor. I apologize immediately out of the gates for the length of that introduction. I will do my best to shorten that down with our comms people, but I am very happy to chat with you today. A little disappointed it's virtual. I would have liked to have actually had lunch in the Okanagan today. It would have been a nice break from Toronto for me, frankly. I figured I would take a little bit of time. I'm going to, I think, share a screen here and just walk through what seems to have happened in the marketplace a little bit pre and then through the middle of COVID. And as we're approaching what is the end of the mortgage deferral period that has been provided through kind of government supports, a little bit of a discussion about what we anticipate is going to happen. Before I get too much into that though, just for the sake of a bit of background for those of you that aren't necessarily familiar with Mortgage Professionals Canada, we are a national association that represents all businesses involved in sort of the mortgage broker originated loans community. By head count, for sure, mortgage brokerages make up the largest contingent, but we also do have mortgage lenders, anybody that uses mortgage brokers to originate effectively. So Scotia and TD are two of the big 6 banks that use brokers. And then Equitable Bank, Home Trust, MCAP First National, quite a few credit unions, and probably every other lender you've ever heard of likely belongs to our organization, as do the 3 mortgage insurers in Canada. So CMHC is a Crown Corp, you're probably most familiar with, as well as Genworth and Canada Guarantee that we call the private insurers, although they do still enjoy a 90% government guaranteed backstop on their risk portfolio. We are an association that represents our members, and so like all associations, government relations is kind of one of the main strategic pillars of things that we try to deliver as a value to those members. At the federal level, when we're talking about what we'll be talking about today, the sort of macroprudential structures. At the provincial level, we interact with each of the regulators as well that would issue the mortgage broker licenses to folks, regulatory practice. We're an education provider, so we do interact with each of the regulators to create the examinations even for qualification for mortgage brokers in many jurisdictions across the country. And because we're an association, of course, membership experience is really what we are trying to create, a community, folks that can support each other, make our industry stronger. We generally do that through events. We have a national conference. We do regional symposiums across the country, as well as pop-up events for just ongoing engagement with members. Now, prior to March 13th of this year is almost the delineation date between when businesses seemed to be operating normally in storefronts and when everybody was basically told to work from home. There's minor variations through that date across the country, but it was a Friday the 13th, and so that's generally the one that I will use as the delineator. Now, there were a number of changes to mortgage underwriting criteria prior to that date, which had pretty significant impact actually on what was happening in the market. And I think Canada as a whole just has a predilection or a fascination really about all things that will potentially impact the price of housing, either because you're a homeowner and it's a sizable investment for you as well as your place to live, or because you're not a homeowner and it seems to be becoming increasingly more difficult for you to achieve that objective. So the stress test gets an awful lot of press. Effectively, there's a fictitious interest rate that you have to prove you can qualify to afford, basically. The first of those was introduced at the end of October of 2016, but it was initially only for mortgages that are insured. So if you have a down payment smaller than 20%, you are required by law to purchase mortgage insurance to protect the lender. And it became more difficult to qualify for a mortgage if you had a smaller down payment. Effectively, mostly first-time buyer community was impacted by that. On the heels of that, OSFI, which is the government regulator that oversees liquidity in the financial sector for both federally regulated banks as well as the mortgage insurers, required mortgage insurers to carry additional minimum capital for the size of their portfolio. And what that really means is they had to have more money in reserve sitting in a bank account as cash. By virtue of that, effectively, it made the premium for mortgage insurance more expensive. And so that, again, in addition to the qualification becoming more difficult, now the products that was required by law became more expensive, really did impact first-time buyers' ability to get into the market. On January 1st of 2018, OSFI, who regulates the banks and the mortgage insurers, decided that that stress test really should be applied to everybody and not just for the folks that were requiring an insured mortgage. And so I'm sure you've heard in the press, B20 is sort of the handle that's given to that particular stress test, but it's really named after the piece of documentation that is guidance to the lenders that OSFI issues about how they should be managing their mortgage portfolio. So that did have some pretty significant impacts. Just for the sake of an example here, for those of you that are not mortgage practitioners, the stress test is a little bit of a misnomer because mortgage underwriting in Canada has always had what is effectively a stress test in place before the loans were issued. We have had, one of the reasons why we emerged from the 2007 crisis as healthily as we did is because we had such a prudent underwriting scheme in place compared to a number of other places around the world. It's actually become significantly more stringent since then, which has really only made our system more robust. But those fictitious interest rate qualifications that are the current stress test are really an additional layer of protection on what was already a stress test in what we call gross debt and total debt service ratios. And I just wanted to show the impact of the additional stress test on purchase price. So in today's market environment, it's easy to do this for the sake of the example, interest rates for a 5-year fixed for most people can now be found at somewhere around a 2% rate. The Bank of Canada posted rate is currently 4.79%, and that posted rate is what's used as the benchmark for qualification now. But before we even look at that, to determine what somebody's gross debt and total debt service ratio maximum mortgage expenditure can be, we do a little bit of math backwards from the gross income. So we determine what the monthly income of an individual or a couple would be. We have to take into account from that monthly income expenses like heating, property taxes. If they have any condo fees, usually that is also taken into consideration, and any of the debt payments they may have, whether it be a car loan or outstanding bank loan for something else that they've done. And then we sort of take that out of permissible expenditures of mortgage servicing. Debt service ratios here are 39% for gross and 44% for total. The lower of those two fees is permissible. And so in a very simple scenario here, let's assume that this particular couple who collectively make $100,000 a year would be permitted as a maximum to spend $2,800 a month to service their mortgage. I had to do a bit of math backwards to provide this example, and I will say very clearly, nobody within our community would ever advocate that individuals should be spending their absolute maximum permissible to service a home. But I wanted to use these numbers really to show you the difference in potential purchasing power of a couple who make $100,000 a year. So if we were using just the pre-existing debt service ratios at a 1.99% interest rate, that $100,000 couple with a $40,000 down payment would have been able to buy up to $685,000 worth of house. When we use the fictitious stress test rate instead of the actual market rate and work backwards, that same couple's purchasing power has a maximum of 517. Now, again, we really don't advocate people run to the edge because you always want to have some cushion in your bi-weekly income to manage surprise expenses. But you can see there's a significant distance here between what an individual could actually financially afford on their bi-weekly pay versus what they will qualify to afford under the now current structure. Because of this reduction in purchasing power, we actually did see some impact in the market. When the insured stress test was introduced, as I said, October of 2017, you can see that there was a reduction in transaction volumes following that, as first-time buyers really needed to raise additional down payment to offset the qualification reduction. Similarly, when the B20 guideline was introduced, which meant that that stress test applied to everybody qualifying for a mortgage, it took the marketplace about 1.5 years of reduced activity before folks that had aspired to become a homeowner had the time to build up additional sufficient down payment to be able to mitigate the reduction in their purchasing power. So
Paul, sorry to interrupt you. I think we're having just a technical issue with the movement of the slides. Could you maybe try and reshare your screen?
I can. I do apologize.
There we go.
I'm doing this. That's my bad. I do apologize. So, stress test. Here's my numbers. For the $100,000 earning couple, you can see when I did some simple math, they have a monthly permissible budget of $2,800 to afford the financing. When we work backwards from that permissible monthly budget, at a 2% interest rate, that couple could afford $685,000 worth of home. When we use the stress tested rate, in addition to the debt financing ratio maximum, the purchasing power is quite significantly reduced there. And so I put this together really just to give a visual example. Once again, we never advocate people spend the maximum, but you can see the pretty significant dislocation here. Nothing's changed in these folks' income at all. It's just the qualification criteria that have. Here is our stress test timeline slide. And so this is what I was talking to a moment ago, but you couldn't see it. Sorry about that. When the insured stress test came into place, you can see there was a reduction in activity through that first period. Took a little bit of time. And just as the market started to respond, the stress test was then applied to all mortgage applications, not just the insured ones. And you can see that period there, about 1.5 years really, where it took the market to readjust and save additional money basically to offset that qualification reduction. Now, you might be wondering, why did this second stress test become required? Well, OSFI's job, the Office of the Superintendent of Financial Institutions, is to ensure that the banking system is secure and stable. Banks are effectively managing depositors' funds, and so they wanted to ensure that banks were not issuing loans that were too risky, frankly. They want to make sure that consumers' money is safeguarded. And when that first stress test was introduced on only the insured mortgages, if you look to the left side of this chart, you can see there were more insured mortgages issued than uninsured. But it became easier to qualify for an uninsured mortgage. And so people were getting to that magical 20% down payment to avoid the additional difficulty in qualifying. And we saw a crossover of now more uninsured mortgages were being issued than insured. Now that means because new loans were being originated, if you just follow the logic in your head on this, the debt or the loan to value on aggregate of the mortgage portfolio of the lenders started to increase, right? The uninsured value of a mortgage book will decrease over time as people are paying those mortgages down. But if suddenly more are being originated at exactly 79% loan to value, that means that the aggregate loan to value of the entire portfolio would start to also go up. And that makes that portfolio riskier. And so OSFI decided we need a level playing field and everybody needs to qualify the same way to help reduce that widening gap that we can see in this slide here. Now, they're also very much interested in, and they still are, this is an issue that's been ongoing for quite a while now, but the debt to income ratio of the average Canadian household has been increasing almost forever, really. But for the sake of a snapshot in time, you can see across the last 20 years that we've gone from just under 100% to somewhere around 175, 176% debt to income. And that is really inversely proportionate to the interest rate trend that we've seen across the last 20 years. Most Canadians will manage their finances on a bi-weekly basis because everybody sort of looks at their cash flow. And as interest rates have come down, additional debt levels have become more affordable. And so over time, people have been able to carry the monthly cost easy enough, but that has hasn't forced, but people have just made it available to themselves additional credit because they can spend money today that they don't necessarily need to pay for until tomorrow. And so this is definitely a concern for regulators as well as sort of central banks. And this is the number that the media also will use a lot. But one of the things that's not really talked about is the household debt to asset ratio. And this has actually been really quite flat. So while people have been taking on additional debt, if I just go back here, they've been spending it on things that have retained their value, and most of that debt is driven by property. And as long as property values are reasonably stable, the risk of that debt level is actually not quite, I think, what media has been portraying it to be. There's significant asset backing behind those. The government also, at the last election, actually introduced, because they knew that it was going to become more difficult for first-time buyers to get into the market, a first-time home buyers incentive program. This actually provides an equity share from the government in the purchase of a home in some quite limited criteria. Household income has to be below 120,000. The loan size cannot be more than 4 times the income. And there's also a minimum 5% down payment required. The mortgage has to be insured. So it's quite a specific and small, limited audience that this is available for. If I quickly go back here, only for the sake of looking at the numbers in the bottom corner, the insured mortgage portfolio in Canada in billions of dollars at the beginning of 2019 was 479. Now, the first-time homebuyers incentive program had an annual budget of 1.25 billion allocated to it, which again sounds like a tremendously large number, but in context of the full insured mortgage portfolio, it's really a very small portion. It was a very, very targeted program. And we're seeing some take up, but not a tremendous amount. And you folks in BC actually will probably be quite familiar with the HOME program. The government was effectively gifting down payments to folks in BC. That program retired with very tiny take up. I think about 7% of what was anticipated took advantage. And the BC program arguably was almost more favorable for home purchases than the federal program currently. We do anticipate that there's going to be some increases in eligibility or a widening of the goalposts for folks to take part in this shortly, which is good news. But initially it's really quite targeted, and so it would not have a tremendous amount of take-up. Now, we did receive an announcement that there was going to be a slight reduction in this stress test at the beginning of the year in February. They were initially going to be uncoupling that Bank of Canada rate, what is currently 4.79, from the test, and instead using a 2% floating rate over market. So today that would mean 1.99 plus 2%, or 3.99 would be the interest rate you'd be qualifying for instead of 4.79. But on the heels of that, we started to see this. On February 18th, I think we were aware that there was a real problem with an infectious disease in certain parts of the globe, and we were starting to become attuned to it. But we had no idea of the speed at which it was going to move. And so between February 18th and March 20th, the number of daily cases reported in COVID was skyrocketing astronomically. And at the same period, the reason why I've picked these 2 dates is if you look at the performance of the TSX through that same window, we lost about 1/3 of its value as people really started to panic about what the speed of this infection transmission was going to do to our economies. We did actually close down businesses around March 13th because we were hyper attuned to what the potential impacts to our friends and families, significantly our older relatives, could be. And as the market started to plummet, there really did become some concern about what was going to happen economically in the country at that point. As I said, Friday the 13th in March is sort of the date that I would use as a delineator for the date when we kind of closed all businesses. And a few very strange things happened with the mortgage marketplace as a result of what was an incredibly tumultuous marketplace here. The Canadian dollar offering rate suddenly started to charge quite a premium. And the way that the market operates, or to set mortgage rates, is usually based upon the cost of investor capital, whether it be bond yields. It's often tied to Government of Canada's 5-year bond, for example. But more often it's tied to a Canadian dollar offering rate, which is a rate that banks will offer to others for a short-term loan. It's a very, very small premium generally, because the rates are based upon bankers' acceptances, which are almost like certified checks. They're future payments that are on guaranteed funds. And because the funds have already been guaranteed, usually if you're purchasing a payment that's to be made in the future, there's a very small discount, and it's very safe capital. Because the market was so tumultuous, we were seeing almost 1,000-point swings in the TSX on a daily basis. There was an awful lot of uncertainty about the ability for a number of businesses to survive such an issue, especially with the shutdown, and an awful lot of uncertainty. Very many business practices were also impacted because of this. People were required to work from home and not able to interact. That did create an awful lot of concerns for us. On March the 11th, just as an example, and I don't even mean to single Scotiabank out for this, they were not alone, but they raised their published 5-year rate from a 3.45% to a 4.05% overnight. And this was happening at the same time, as you'll see in just a moment, that the Bank of Canada was actually reducing its overnight rate. They were basically fighting against what was the marketplace starting to risk premium or charge or require an additional spread between the money they were lending and what they were receiving back. It caused an awful lot of confusion in the short run. For home sales that were in the process of transaction at the time of the shutdown, there was an awful lot of confusion. Most homes are sold conditional to an inspection or some sort of a survey, and the inspectors themselves were not able now to conduct their service because they weren't allowed to interact with folks. In some regions across the country, the land registries were actually closed, even though they were deemed essential services. 1 or 2 of the municipalities actually just closed their doors. Lawyers also couldn't see people to sign. And then, as just sort of the icing on the cake in the mortgage broker industry, the largest technological connectivity provider that usually facilitates interactions between brokers and lenders had a 4-day outage at a time when the industry really wasn't able to offer any services. Mortgage rates were going up. Brokers weren't sure if they'd had confirmations of the rate that they were trying to lock in the day before. There was just a tremendous amount of confusion. On March 18th, you'll recall, possibly anyway, maybe not the exact date, the Canadian Bankers Association made an announcement that, understanding there were going to be an awful lot of people who would find themselves with their income impacted by this outbreak, they would allow deferrals of mortgages for folks on a case-by-case basis. This was the initial announcement. I put the emphasis in myself. Their announcement wasn't quite as bold and highlighted as this, but the intent was quite specifically to be determining on a needs basis who would actually require one of these deferrals. But there was so much reporting of this by the media, and in many instances, the headlines actually really misreported what the intent of this program was, suggesting that everybody that had a mortgage would just get a holiday for 6 months. The phone lines for all of the lenders were absolutely inundated with requests from people, obviously, to take advantage of those. At the high point, I think there was something like 500,000 calls in a single week that were made through to phone systems. A lot of them just went down. And so the lenders, in a very short run, realized they really didn't have any alternative but to just extend a deferral to anybody that asked for it. There was no way operationally that they could practically conduct any kind of means test on folks. And so there was an awful lot of reporting about the size of the people taking part in those deferrals. But I think we know now, we definitely have the benefit of hindsight, a significant number of people that took those deferrals really didn't need to at all. I think potentially psychologically they did, but from a cash flow basis, they didn't. I think an awful lot of them were just very anxious about the uncertainty that was coming, and figured if there was a way for them to avoid a mortgage payment and just shore up some cash in the short run, it would certainly help their own psychological place in their mind. And so that's effectively what seemed to happen. In the midst of all this, the federal government and the related agencies did a tremendous amount of work in a very short period of time to try to make sure that we provided some calm and reassurance to Canadians through what was a very, very stressful time for everybody. OSFI, who was the federal banking regulator, announced a reduction in the domestic stability buffer, which is effectively a freeing up of capital for lenders. And by reducing it by 1.25%, it actually freed up about $300 billion of liquid capital that the banks then had available to issue as additional lines of credit or extend lines of credit to support individuals and businesses who would suddenly find themselves in a pretty significant cash flow deficient position. They changed the treatment of loans that were in deferral from non-performing to, I think they call it an emergency measures contingency. In normal times, if a loan is in deferral, a bank would have to retain additional minimum capital to sort of offset the risk that that loan never becomes performing, and they have to service the loss of the indebtedness. By allowing banks not to have to label deferred loans as non-performing loans, it again allowed a whole bunch of additional liquidity for the lenders to be able to continue to issue and support the marketplace. They're also able to increase the number of covered bonds that they would purchase. And this is, again, kind of a technical point, but it reduced the minimum capital retention that the banks had to hold. A covered bond effectively acts similar to a cashable instrument as far as the regulator is concerned. And so it really, all of those measures ensured that the banks just had as much liquid cash as possible. The Bank of Canada reduced its overnight rate in the space of a month from March 4th to March 27th from a 1.75% overnight rate to a 0.25 rate. They've also started buying corporate debt. And they've done this really to try to keep interest rates as low as possible. As more businesses were issuing their own bonds because they needed cash, investors, as we've said already, were looking for a risk premium. And so the Bank of Canada, to keep those interest rates low, effectively said, we'll buy them instead. So rather than exposing yourself to a higher rate investor appetite, we are confident that we can continue to support your business through other economic means. And so we'll also buy your corporate debt and we'll keep that interest rate pressure down. Canada Mortgage and Housing Corporation also manages now an insured mortgage purchase plan. It was initially introduced actually through 2007, but they reignited it and basically said initially about $50 billion worth of capital announced. That was very quickly increased to $150 billion. So that all banks and lenders could package up their mortgage portfolios and sell them to CMHC, who would then securitize those loans, effectively guarantee that the payments on those mortgages would be made, bringing cash back to the lenders and so they could continue to loan. Once again, it's very much a liquidity support. And the Ministry of Finance, as you know, there were all kinds of programs to help individuals and businesses with their cash flow position through that period. I've already done all this and I realized I created individual slides. So this is just a quick visual to explain how quickly the Bank of Canada moved on its interest rate reductions. So we were a 1.75% overnight rate right up until March 4th. They took 50 basis points away from it, realizing that they still needed to do more. They took another 50 basis points away 2 weeks later, and then they took another 50 basis points away 2 weeks after that. It was a very, very quick reduction in interest rates because they wanted as quickly as possible to reduce the cost of credit that was necessary to continue sort of the cash life flow, if you will, of the businesses in Canada. This $150 billion that was reintroduced by CMHC really did help banks with their liquidity. It's a very simple sort of securitization 101. If you're a bank and you issue 5 loans at $200, if you sell those loans to CMHC at a $1,000 bond, CMHC will package those up and issue them into the market. Because CMHC as a Crown Corporation is guaranteeing the performance of the mortgages within that credit bond, the interest rate payable to the investor is very, very low. It's effectively risk-free because it's government guaranteed. So there's enough of a margin there that everybody is able to cover their servicing costs. And by selling it out to the market as an investment mechanism, the revenue that comes back in is again liquid capital that allows the lenders to continue to issue credit. And it's the government guarantee specifically that keeps the interest rate payable to the investor as low as possible. So that was also, they moved very, very quickly on that. Tremendous program. The innumerable measures that the Ministry of Finance put forward, if you visit their website, this list seems to go on in perpetuity. They have been very, very flexible, and they've introduced an awful lot of programs. CURB gets a lot of press. There's a lot of wage subsidies. There's an awful lot of rental subsidy programs, and then there are specific community programs. They very much acknowledge cash flow is an issue when they have effectively ordered the closing of businesses, and they've done a tremendous job very, very quickly to ensure that people still have working capital. September and October, we're going to find ourselves in a real kind of transition period now. A lot of the deferral programs are going to expire in September and October, and so people are going to have to start making payments on those mortgages that have been deferred. Because we know a good number of those folks took advantage without necessarily needing the cash flow relief, we've actually seen in the earnings statements actually of the banks across the last month, and even just from within the lenders within our community, very encouraging numbers about how few folks are actually still in those deferral programs. Quite a lot have opted out and started voluntarily making payments again. They've realized that they're capitalizing the interest that they're avoiding, and so if they're able to make payments, they've actually started again. So there will be some that find themselves in harm's way, but nothing like what we had initially anticipated. Immigration into Canada is effectively stalled. We had somewhere around 500,000 new entrants on an annual basis prior. That's going to be very, very small this year. And with travel and with the Airbnb market, or those short-term rental properties that we have now also finding that they're really not generating any cash, that's going to have an impact on the number of homes that really are available for sale, as the people that have to sell because they can't meet the deferral find that time has come due, and investors who are just not making a return or carrying a mortgage that they don't want to pay for anymore. So we are anticipating that even though there isn't going to be a deferral cliff per se, there's a number of factors economically that are going to create additional inventory in the housing market, and that in some areas of the country is likely going to cause some softening. We're also, it seems like at the beginning of the predicted second wave now, that is going to mean that there's a continued lockdown in various definitions of that across the country as we see. But it is also going to impact continued economic activity. We've been fortunate through the summer that patios have saved a lot of restaurants. When the winter comes and it's too cold to sit outside arrives, I'm not quite sure what's going to happen there, but there's definitely some additional impacts to consider. Now, Mortgage Professionals Canada has run consumer surveys for a good number of years now, where we've asked Canadians how they feel about the housing market in general. Is real estate a good long-term investment? What do you think about current interest rates? What weighting of investment versus a place to live do you consider when making a purchase of a home? And we would traditionally have gone to market to survey those Canadians for the traditional survey anyway at the end of May. And we realized we were very much, we had hoped anyway, at the bottom of the trough of marketplace activity then. And so a snapshot in time right there, we didn't think would provide much value. Instead, we've pivoted a bit and we're conducting 4 mini surveys through this mortgage deferral period, where we'll survey consumers about how they feel about the housing market as that additional inventory starts to arrive. And we may see some softening in prices, as I said, in some places. The first 2 are already out. The next 2 will come sort of October and December. These are available on our website. First one is really just benchmarking. That arrived at the beginning of July. The most recent one was just a couple of weeks old. And because of the resurgence in activity that we saw, we did actually see some encouraging news about marketplace confidence already in just the 6-week period between the first and second report. It'll be interesting to see how it evolves. My chief economist keeps reminding me that we've been surprised every single month that we've been looking at marketplace activity since March. We would be foolish not to continue to be surprised. So we're definitely watching it closely. We've got some sort of soundbite data pieces from these reports that are available also on our website. This will be no surprise to anybody. As I said, I think everybody tracks the housing market pretty closely. While the second quarter of this year was a precipitous drop-off of what was anticipated to be a pretty busy year, the pent-up demand that created, as well as the amount of activity that I think is new, caused by people reevaluating the place that they're living in a lockdown, not necessarily being suitable for them anymore, created a tremendous amount of rebound. Now, I'm not sure if it's sustainable. I think we're definitely going to plateau soon. But again, my chief economist keeps warning me not to get too deep into predictions, really. CMHC is reporting that roughly 760,000 mortgages, that's 1 in 6, did take advantage of the deferral or at least skipped 1 payment in the last 6 months. But again, I think that misunderstanding of how those programs are supposed to work definitely drove behavior. And our expectation at the industry level is that there's only really going to be somewhere around 1% of mortgages that will need assistance after October. And there are programs already in place to assist those folks. Just because the capital treatment of those deferrals will change from the regulatory perspective for the lenders, that doesn't mean that the lenders cannot continue to offer deferrals. They just have to manage the capital treatment of those now deferred loans differently after October. So there will be some that will continue. The mortgage insurers also are making some concessions there as well. It's not good for anybody to have an awful lot of inventory suddenly hit the market, because if prices go down, that actually affects the security that all of the rest of the mortgages are using as collateral against the loans that are issued. So it's in nobody's best. It's also very expensive to liquidate a property if you do actually have to foreclose in it. I think everybody in our industry's preference is to help everybody retain their home if at all possible. The Bank of Canada did some projections regarding what the deferrals have done to assist people stay in their homes. And so you can see what would have been a pretty aggressive rate of people losing properties. I think the program has been incredibly successful. Oh, wrong page. There's the slide. Sorry. And the next 6 months, given that the short-term rental space is more or less dried up and we don't have the same immigration levels, I think you're going to find, first of all, a tremendous softening in the rental space, and that will probably have the largest impact on the investor rental market. The purpose-built rental stuff is probably going to be pretty solid, but the individual investors that are renting out may find it harder to generate enough cash as those rents fall to cover all of their expenses. That may trigger some movement. We're also going to see some regional impacts as the areas that you would anticipate being most economically challenged by some of these changes persist with that. Oil is going to be low for quite a long time, I think, so Alberta and the Atlantic provinces may well see some difficulty, although remarkably in the last 6 months, the Atlantic provinces seem to have done better than anybody else in terms of resale activity and valuation increases even. CMHC restated that they believe a 9 to 18% correction at the national level in home prices is possible. 18 is pretty dire. I know that number is quoted all the time. I don't think that's their intent. I think they believe 9 to 10 is more realistic, but they are a risk averse body, obviously, as an insurer, and so they definitely like to make sure that they cover their bases with their projections. Other real estate firms are looking at something closer to a 7% reduction, but it will be pocketed. I think there's going to be areas in Vancouver Central, for example. It'll be likely the high-rise condominium market that will see most of the softening, that will on average pull things down, but single-family detached homes are so scarce and probably even more desirable now, considering if you have to stay in your home forever, you want the extra space. So those prices are probably going to be pretty solid. It will really depend upon the region, but you can rest assured, I think, that the federal government is also keenly attuned to what's happening even in regional pockets and doing the best to make sure that they minimize the impact of what is likely to unfold. I think there are a few questions in the box here, so I'll pass this back to Luke to sort of manage how we progress through those. But once again, thanks very much indeed for the opportunity to chat today. I very much look forward to answering the questions here.
Thanks very much, Paul. Yeah, I will say there is a Q&A chat box here in Zoom, so please feel free to add some questions there. And as we do have a few minutes to go through some questions. It's unbelievably, it's amazing. The snapshot that you provided for us doesn't feel like a 6-month window of time, given all of the changes in the regulatory environment and all of the programs that put into place. You know, they would have a very hard time doing any of those things over a full government's term, let alone in 6 months. So maybe I would start there federally. Just you touched briefly. Looking to what the, you know, if you have any insight early on the throne speech from earlier, I guess yesterday, and whether anything from the home buyer incentive or the national housing strategy, what are you seeing from the throne speech?
So it's really early to tell. The speech was very encouraging, but it was really light on details. When it talked about the increases in the first-time home buyers incentive, my suspicion is they're referring to the already announced increase limits for income maximum and multiples that were made at the last election, and quite specifically targeted actually at the Greater Vancouver area and Victoria, as well as the GTA. So I don't think you're going to see those increases anywhere else, but hard to say yet. I haven't seen anything further. We will definitely be in touch with the policy folks at the federal government in the next couple of weeks to chat about where their mind is at and to hopefully direct some of that. Additional spending through the National Housing Strategy, which is the document and the plan actually that CMHC have been charged with looking after, is also really encouraging. Housing is very much a continuum, and so the more support we're able to provide for low income and social housing, the better. That certainly does put less strain even on some of those, what would otherwise have been affordable rental spaces and therefore affordable, I should actually say accessible housing. Affordable paints a bit of a different picture, but we definitely need more supply. Like all of the changes that have happened in the mortgage space across the last while to make homes more affordable have really just excluded people at the bottom end of the economic ladder from purchasing. And so even if they had been successful in making house prices fall, they actually wouldn't have helped the people that we would socially expect to have been helped by those changes, because they just wouldn't qualify for even the reduced prices any longer. I'm very encouraged by anything at all that addresses shortages in supply, because in my mind, that's the only thing that is practically going to bring prices down, but still permit people to actually get a foot in the door, as it were.
Yeah, that is certainly music to the ears of our membership. I mean, there's only so much you can do from a demand side, and certainly as private development industry, advocating to work with the federal, provincial, or municipal governments in adding more supply is a key driver and a key lever that we think we can help pull as it relates to affordability. You did touch on kind of the overall condition of the Canadian residential mortgage market. Is it fair to say that you characterize it as still quite solid despite some of the noise over the past 6 months?
Yeah, I would say so. I think there was almost a pause as everybody held their breath through March, April, and most of May. And then I think as people realized that business was still being conducted, albeit from their kitchen table in May, a lot of people that probably were not sure if they would continue to have a job and were worried about their income realized the globe has been affected by this. And so even though my working style has changed, my job is probably secure. And I think once that realization took place, that's when we started to see that real takeoff again of transactions across the country. Because people really did start to realize, oh, wait a minute, if I'm going to have to do this in perpetuity now, this 600 square foot condo that I'm in is not really conducive to my young daughter and trying to find space for the office that I can dedicate. The building runs fire alarm tests pretty regularly. I can't be on a Zoom call while that's going on. So there really has been a reevaluation, I think, of folks and the security of their employment. For those that are salaried anyway, I think has returned pretty strongly for most.
Yeah, so I guess on a sort of related question, we've got a question here from Andrew Bruce. And the note here is, if strata fees are part of the test for qualification, are you concerned about the recent trend in massive insurance premium hikes? So much policy direction is for densification and housing, yet this will make it harder to purchase in a condominium environment.
It's definitely a consideration out there. Yeah, I know I have some good, I was previously in the insurance industry. So as it's been explained to me, at least specifically in Vancouver, it's actually the cost of the reinsurance that the insurers buy that has gone through the roof. And because it's been so long since you've had an earthquake in Vancouver, the reinsurers are nervous that the longer it takes, the bigger it's going to be. And that's why premium charges have really significantly increased over time. If the condo fees are covering the condominium corporation's policy, and there's a necessity to start to double or triple or quadruple those fees, some of them are, I've seen one that's 10 times more, almost it's eye-watering in some instances. That's definitely going to impact the bi-weekly incomes of people for sure, and what has to be considered as part of the expense for their cash flow. So it will actually, it might handcuff some people to their condos because they will find that there's nobody able to afford them, given that the size of the condo fee becomes such a large component of the expense to carry it over time. It's not an enviable position to be in. I don't have any immediate solutions for that either, unfortunately.
Maybe we'll just gonna do one more question here. You noted that our lending requirements or the underwriting requirements generally in Canada are stringent. That in some ways, I guess we would be one of the world leaders in terms of the safety of that system, I suppose. But do you think we're striking the right balance between, accommodating those risks, but having a healthy enough market that people can get into and qualify for mortgages?
So thank you very much for the question. I could have mailed you that one. It leads in very nicely to a lot of the political positions we've taken for an awfully long time. Now is a very strange time to be talking to government about reducing their view on risk. They just don't have the appetite to do that at the moment. But prior to the shutdown, I would definitely have said that setting the stress test at the Bank of Canada rate is too onerous. It really does reduce people's ability to get into a home, and not because their cash flow position has changed, really, just because the qualification guidelines around their qualification has. There's an awful lot of folks, if I equate it back to the debt service ratio calculation at the beginning of the presentation, if you are limited to 35% of your income, CMHC actually very recently changed their guidelines to reduce the debt service ratio is allowable actually. And then to put a stress test on top of that, when you do the back of the napkin math calculation, if you have 10% down and so you need insurance today, mathematically it works out you're only really allowed to spend 28% of your income on your mortgage. I'll bet you there's an awful lot of people renting, paying significantly bigger chunks of their paycheck to manage their living expenses. And they've probably got great payment history, but those folks no longer qualify, not even considered really, to be able to purchase a home now, because mathematically, then they're just not eligible. So it definitely needs some examination. Right now is not the time to be approaching government really to make those types of changes. But as we arrive at something closer to an equilibrium, that previously announced uncoupling from the bank rate to something around a 2% number is definitely something we will be much more supportive of.
Great. Well, I think that's a good place to end. We're almost out of time. So, Paul, certainly really appreciate all of your time and giving us some insight into, again, what feels like quite a period of time, but over the last 6 months, and getting a little bit insight into the next few months here. So with that, we'll kind of close the webinar. Again, obviously want to thank Paul. I want to thank our sponsor, Valley First, and thank all the attendees for joining us today. I'll remind you that the session here is recorded. It will be available on our UDI website. And I certainly encourage you to contact Jen at the UDI office, and the coordinates are here. If you have any ideas for future webinars or events that you'd like to see in the future. So with that, thanks very much, everyone, and hope you have a great rest of the day.